ETFs have absolutely exploded in popularity over the past 20 years. There is now over $7 trillion invested in ETFs in the United States alone. They're beloved by everyone from beginners to professional investors. But what makes them so special? What is an ETF, an exchange traded fund? Today, I'm breaking it all down in the simplest way possible. And by the end of this video, you will understand exactly what ETFs are, how they differ from mutual funds, and why they are so popular, and whether they might be right for you in your portfolio. So let's jump in. Let's start with an everyday example. Imagine if you walk into a grocery store and you want to buy ingredients for the week. You want fruits, vegetable, grains, snacks, and maybe something fun for the kids like ice cream or whatever it is you want to buy in the grocery store. So you could walk aisle by aisle and pick everything individually, or you could grab a pre-packaged grocery bundle that already includes a balanced mix of everything you need. That bundle is what we call an ETF. So instead of you buying individual stocks one by one, like buying Apple, Microsoft, Amazon, Coca-Cola, and the rest of those big companies, right? An ETF lets you buy a bundle of many companies at once. So when you buy one share of an ETF, you're getting a tiny piece of every company inside that bundle. So you don't have to do research on each of the company. You don't have to have a lot of money to buy all the company. You don't have to also decide how much you want to put into each of the individual companies. The ETF does the work for you. So that is the core idea behind an ETF. An ETF is a basket of investments that trades just like a stock. Now let's discuss how ETFs actually work. I want to walk you through a real example. And one of the most popular ETFs in the world tracks something we call the S&P 500. The S&P 500 is the 500 largest company in the United States. So an ETF provider like Vanguard can create funds by buying all 500 companies in correct proportion. So they divide that big basket into millions of ETF shares. Now, let's say you open your brokerage app and you see that one share of this ETF costs, let's say $200. When you buy one share of, let's say, that ETF, you own a small piece of the companies in there. So if the ETF has Apple, Google, Amazon, you own individual small pieces of those hundreds of companies in that ETF. So if those companies, if they grow in value, the ETF also go in value. If some go down, the ETF might also go down or balance out. The key difference between the ETF and mutual fund is how they're traded. So ETFs trade all day long, just like stocks. You can buy or sell them anytime the market is open. But for mutual funds, in our last video, we mentioned that you can only buy at the end of the market close. So that flexibility is one of the biggest reasons ETFs are so popular. Now let's talk about the types of ETFs. Just like mutual funds, ETFs come in many varieties. Let's break down some of the main types of ETFs. The first is index ETFs. These are the most common. They track a specific index like the S&P 500 or the Nasdaq 100 or the total stock market. Examples of those are SPY, VOO. Those all track the S&P 500. And then you have ETFs like VTI that has over 4,000 companies in it, right? So those are popular because they're low cost and they provide you massive instant diversification. We also have sector and industry ETFs. So let's say you want to invest in a specific industry like energy, there's an ETF for that. Example of those are technology sector, healthcare sector, energy sector. So you don't pick individual stocks, you just pick stocks in those sectors. Then you also have bond ETFs, like I mentioned in one of my previous videos, right? So you have ETFs that have different type of bonds in them. For example, you have long-term treasury bonds, which are perfect for conservative investors who want stable income. You also have international ETFs. These ETFs invest in companies outside of the United States and give you global exposure. Example of that is VXUS, which is the total international stock market, which is the total international stock market except the US. They give you diversification and exposure to other countries. You also have commodity ETFs that track commodities like gold, silver, or oil, right? Example of that is GLD, which tracks gold, or SLV, which tracks silver. So these are more volatile and very specialized, and I wouldn't even advise going there. Then you have thematic ETFs that bet on specific themes like clean energy, or for example, now the hot thing is artificial intelligence. And you also have dividends growing ETF like SEHD, which is dividend focused. So this can be fun, but they're also very highly speculative and risky, except the dividends one, which is more stable. So why do investors love ETFs? What are the major advantages? The first thing is that it has incredibly low fees. This is huge because most index ETFs have expense ratios between 0.03 and 0.20 per year. And that is just very cheap. For example, Vanguard S&P 500 VU has 0.03 per year compared to actively managed mutual funds that might charge you 1% or more. So over decades, that 1% is going to compound, and you will see the difference that you're saving if you invest in an ETF. You also get instant diversification with one purchase. So you can own hundreds or thousands of companies when you buy one share of an ETF. For example, if you buy one share of VTI, you own 4,000 US companies. That's like, it's so impossible for you to buy that by yourself, right? And buy individual 4,000 companies. The other point is that it gives you control. So if you want to buy at 10 a.m. or 2:30 p.m., you can go ahead and buy. With mutual funds, like I said, you have to wait until the end of day pricing. ETFs are also structured in a way that they make them more tax efficient than mutual funds. So in mutual funds, you might get dividends distributed among the holders of that fund, but ETF rarely distributes capital gains, so you don't have to have like a surprise tax bill that that will make your taxes go up again. So another thing is transparent. Another advantage is transparency. So with ETFs, you know what is being held in the ETFs. You can see the stocks, the bonds in it instantly. And another thing is accessibility. There's no minimum investment when it comes to ETFs. Some even allow you to do fractional shares for like $10, even if the ETF costs like $500, right? Let's talk about the downsides. The first is the trading cost. ETFs themselves, they have very low fees, but when you buy them, because they're being traded every day, you might need to pay a commission to buy or sell them through your broker. But most brokers now offer commission-free trading. So if you invest in small amounts frequently, even those tiny costs can add up in the long run. Then there's something we call the bid-ask spread, which is the difference in what buyers are willing to pay and what sellers want. There's always a tiny difference when it comes to ETFs, and the spread can just be 1 cent or it could be 50 cents. So that's an eating cost that over the long run also compounds. The third disadvantage is the temptation to overtrade. So because you can trade ETFs all day, some people tend to buy and sell them constantly. So because they try to time the market, this usually would lead to the worst returns than them just buying and holding. And the flexibility can be very dangerous for people who are very impulsive. So some ETFs are also complex. The examples I've mentioned though so far are very simple ETFs, but there are some ETFs that are complex, that are betting on the collapse of a company or an economy. Those are not for beginners, and you can lose your money fast. So you need to I would recommend sticking to simple ETFs when you're starting out. Another disadvantage is that there's no automatic investing. So with many mutual funds, you can set an automatic monthly investment of any dollar amount. Let's say you want to invest $100 per month, you can set that. But with ETFs, it's a little bit trickier because you have to buy the whole shares at the market price. But many brokers now, actually, they're starting to work on investing automatically for the ETFs. So that should be solved very soon. How do you choose an ETF to invest in? The first thing you have to look for is you have to understand your own personal goal. Let's say you want international exposure, you choose an international ETF. If you want stability, make sure you have a bond ETF. If you want growth, you choose a growth ETF, right? If you want a specific sector, you focus on that. Then number two is you want to check the expense ratio. So the lower the better. So for index ETFs, everything is usually under 0.20%, which is very great. But there's some that is even 0.05%, which is just phenomenal. You also want to look at the trading volume. So higher trading volume means you have tighter liquidity, you have very good liquidity, very small bid-ask spread. And another thing you want to do is check the tracking error for index ETFs. You want to see how closely it tracks the underlying index. So a good S&P ETF should match the S&P 500 mutual fund that it's tracking, right? So small differences, they're normal, but big gaps are very, very big red flag. How would I also look at what to invest? I want to review what is in the ETF, right? So I want to see what is in a specific ETF I'm buying, what are the holdings of the ETF. Another thing I consider the fund side, which we call AUM, which means assets under management. So how much total money is in that ETF? The bigger, the better, generally. So if large ETFs are more stable and they have less potential to shut down. My preferable AUM is about anything over 100 million and 1 billion. So I also want to check the fees. Low fees, the lower the fees, the better. The lower the fees, the better, right? I want to see fees between 0.0, no fees, or 0.03. That would be my maximum for literally an ETF. So in conclusion, let's wrap this up. An ETF, or exchange traded fund, is a basket of investments that trade on the stock exchange like a regular stock. You get instant diversification, professional management, and incredibly low fees, and it's very tax efficient, and the stability to trade anytime during the trading market hours. Might start with a core holding like VTI or VOO for US stocks, and had some international exposure with VXUX, and maybe a bond ETF like BND for stability. So that's a rock solid foundation. If this helped you understand ETFs, give this video a thumbs up. What ETFs are you most interested in? Drop it in the comments and subscribe for more investing contents that actually make sense. Thank you for watching, and I'll catch you in the next session.